should say, I am on. No, we are on. You cannot see Wesley. He is behind the camera. Jack is not in the office this afternoon, so I'm at the helm. We will see Jack when we see Jack. What a day. What a week. I know it makes you just want to pull out your stress balls, right? Stock markets retesting the June lows, down over 20% year to date. Investor pessimism is at 2008 era levels. Inflation appears stickier. The Fed will continue its path of hiking rates for longer. Recession risks are increasing. Lions and tigers and bears, oh my. I don't mean to make light of this, but I will make light of this. The news is terrible. We cannot ignore that fact. But this is not our first rodeo. And for most of our viewers, it's not their first rodeo either. For some of you, though, it may be. And so I want to revisit some tried and true things to keep in mind to maintain your perspective as we're going through a down market. So, as I said, you've heard all this before, but it bears repeating, no pun intended. First thing, the news. Yes, the news flow is very, very negative. My suggestion, turn it off. Turn the financial news off. I looked on CNBC today, and the banner all day long is or has been markets in turmoil. Markets in turmoil. Well, here's the thing to bear in mind. Long-term investing is boring. It's not newsworthy. So when you turn on the financial media, you will quickly see that it's catering to traders, and the people that they bring on their show, they are playing off of fear and greed, right? It's all about the emotions. Something else to remember about the news flow. If you're reading about it, the market already knows about it. So it's priced in. There's nothing that you will read in the newspaper or read online or hear on the radio that most market participants don't already know about. Here's something else about the news flow. There is a danger called extrapolation, and we've talked about this a lot. And what happens is that we tend to focus on that which is most recent. So the most recent news flow in this case, well, it's negative. So it's very easy for us to look at the news flow and then extrapolate that it can only get worse from here. Well, conversely, when we're in a big up market, the news flow will make you to believe that it will only go up from here. It's very tricky. But here's something that I want everyone to remember, and this is very important. Markets begin their recovery before the all clear presents itself. So yes, the news flow can continue to worsen. We could see the U.S. go into recession. We will likely see more interest rates from the Federal Reserve Bank. All of this is known and understood. But the thing about the markets is that they discount, meaning that they factor in all available information, past, present, and a reasonable expectation of the future. And so the markets will be looking through the bad news to the eventual recovery. And markets do eventually recover. Something else is perspective. Bear in mind why you are investing. What is your time horizon? For most of our clients, they are investing long term. They have long-term investment goals, such as retirement. So when we have these ups and downs, though they can be unsettling, it should not get us off the track, get us off focus that we are investing for a reason. we're investing with a long-term goal in mind. And we don't want to get out of the markets and disrupt the probability of us hitting those goals because we're moved by emotions. And that gets to my next point, why we are invested in the markets. We're investing in markets, financial markets, because we are seeking to achieve higher returns on investment than we can get putting money in the bank. It's as simple as that. We're investing in stock markets because we are expecting higher returns on investments than what we can achieve in bond markets. We combine stock and bond investments to give us a reasonable rate of return without undue risk. You see where I'm going with this. This volatility that we're experiencing, though unsettling, it's normal. Volatility is a feature. It's not a failure of financial markets. There is no such thing as straight line performance in financial markets. None. And the reason for that is that markets, and specifically individual investments, are marked to market, which means that their prices are constantly being adjusted based on supply and demand for the security. So it's pricing in real time. If you don't want volatility, then you need to put your money in the bank and you will have a straight line performance, but it will be like this. But when we invest long term, this volatility is part of it, but we're investing with the object of getting us on a higher trajectory than the straight line low performance that bank deposits offer us. But even like a bond, we invest in bonds for income, but also for preservation of capital and to diversify an investment portfolio. But bonds mark to market, just like stocks mark to market, and we see bond prices fluctuate up and down. But here's the thing about a bond. When you invest in a bond, you put money in and you have a stated maturity date. And so the price will fluctuate up and down, but as we approach maturity, the price will converge to par or face value. So a bond is a loan, basically. So if you put $1,000 into it, and let's say the price is fluctuating because of market conditions, and specific to bonds, it's interest rate risk. And right now, interest rates are moving higher, and that's pushing bond prices down. Well, that can be a little disconcerting, but provided the issuer doesn't go bankrupt, the prices do recover to par value at maturity. So if we hold a bond to maturity, we're good. We get our principal back. We've earned all those interest payments, provided that the issuer doesn't default. But I'm losing money, Bill. Okay, we hear that. We understand that. And we are very empathetic. You're not losing money unless you sell. I'm serious. Going back to the bond example, that price will recover with certainty if the issuer doesn't default. You just have to stay the course. It will come back. And as I stated earlier, broad market sell-offs are eventually followed by recoveries. And we are experiencing a broad market sell-off. So what happens when we experience these sell-offs, it's basically a revaluation. So you're not losing money per se, but the markets are revaluing your investments based on current conditions. So current conditions are such that the present value of investments are now lower based on a present value calculation that takes into account interest rates. So keep your peace. Keep your peace. We will get through this. If you are very concerned about your investment portfolio, I would suggest talking to an investment advisor. If you are unsettled by the volatility and you would like to learn about how you can put together a portfolio that is less volatile, that will still provide you with an acceptable expected rate of return, we can help you with that. Without getting into performance numbers, which I won't do, I can tell you that the portfolios that we have crafted here are holding up reasonably well. And we're very pleased with that. So I'll just leave it at that. Now, I want to transition, if I may, because we are getting questions from clients and friends of the firm wanting to know about what's been going on in the last 3 months since the acquisition. For those who are tuning in for the first time, Eagle Financial, based in Shreveport, Louisiana, was acquired by a large registered investment advisor, WealthCare, 3 months ago. And since the acquisition, we have been very, very busy here. In addition to the day-to-day work that we do, managing client portfolios, servicing our client relationships, we have been learning, getting up the learning curve as we learn and adapt to WealthCare technology, operational and compliance procedures. There's been lots of new faces. Jack and I attended an annual conference in Richmond, Virginia for WealthCare, and we got to meet our new colleagues and as well as advisors. WealthCare is a large firm with 171 advisors. It has 36 home office employees. So lots of new, shiny, happy people, as REM, the band, would refer to. And it was very fun at the conference, meeting people, talking to them, collaborating, sharing ideas. And we were constantly getting this question, how can we help you guys? So that's very nice to know that our parent company is very interested in our success. They're very interested in how they can help us help our clients. WealthCare at its core is a technology firm, and we will be spending time on a future episode talking about its primary technology platform, which is a financial planning platform. But we have been integrating into other technology systems that are helping us help our clients, like, for example, a client relationship management system, a new performance reporting system. These technologies help us with efficiencies. They help improve the client experience. And for two dinosaurs like me and Jack, it's pulling us into the modern era, and that's a good thing. Wesley, you would agree with that?
I've said nothing.
You've said nothing. You've said everything. Thank you. You know, something else that we're exploring is investment models. So WealthCare has a platform of investment models. They have models that were developed by their home office investment team. We've met with the team members, and these are very, very sharp individuals. But in addition, we also have the ability to create our own Eagle Financial investment models. So we are exploring how we can take our investment ideas, put them into an investment model that will automatically invest and rebalance. So that's something that will create efficiencies and improve our client experience. Now, next week, as I alluded to, we will have a show where we will be discussing GDX 360. So this is WealthCare's proprietary goals-based financial planning system that they developed. And this system is very powerful. It incorporates investment portfolio performance with client goals, and it will give us the ability to show our clients how they are progressing using an assessment, a numerical assessment, how they are progressing towards their stated goals. It's called a comfort zone score. So this is something that we are very, very interested in rolling out to our clients. We are learning, getting up to speed on this, and this is something that we will be embracing and encouraging all of our clients to utilize. The last thing I wanted to give everyone an update on is Wesley, the man behind the camera, the man producing this show. We are getting questions from clients and friends asking about how Wesley's doing. For those of you who don't know, Wesley had a gastric sleeve procedure, and this was 1 month ago, and he is doing terrific. So he's been back in the office, hitting his targets, doing what he needs to do, and it's been wonderful. And I'm also going to toot his horn and telling everyone that WealthCare has recognized his talents and capabilities, and so he is doing special projects for the marketing team at WealthCare. So very, very happy with Wes and his progress. So that is really it. That is a wrap for today. Thank you, everyone, for tuning in. Keep your peace. The world is still spinning. The sun will rise tomorrow, and keep doing what you need to do to get you to your long-term goals. Have a good weekend.